One thing I did want to get your take on before we wrap up is, people will occasionally look at a company that's gone public and say, oh, well, it's trading 15% where shares were offered. That seems like a broken IPO to me. I think that it's worth diving into that and kind of understanding the incentives of a public offering.
Yeah, so what I always look at, and I hate the term broken IPO or mispricing, where if a company stock drops, it doesn't mean it's a broken company in any way. So how I like to always talk about it is say you run a bakery and you spend years sourcing the right ingredients, perfecting your recipes, and then you go to open up shop, but then someone's like, hey, we'll do that offering to the public. We'll run that in front of the shop. We'll buy your we'll buy your pastry for $10. It might have cost you $3. And you're thinking, holy crap, yeah, that's a lot of money. Let's do that. Then you walk out on day one and you look up at the board and it's $18. And you're thinking, how much money did I just leave on the table? Now, if you do a secondary offering down the road or anything like that, yeah, you might want that $18 where then they just jack it up to 24 or whatever the market's paying for it. So that's where I really encourage companies for these direct listings if they can. Now, if they need to raise capital, by all means, price based on what the market's saying. Seeing these big pops doesn't mean it's a great IPO. It just means, hey, those investment bankers and their very wealthy clients are now more wealthy. So you can almost see it like these companies build themselves up over a decade, and then these investment banks make their clients as much money in one day as those people made over the last 10 years. So I'm not a huge fan of these IPO pricing or these huge pops because I feel like they left more money on the table. But a company like Smile Direct, where I think that is a phenomenal company. I bought it myself because I thought the market reacted incorrectly. But to call that one a broken IPO just doesn't make sense because, hey, they made more money on that day of the IPO. Sorry, the investment banks and their clients don't have as much money in their pocket as they did when they bought on day one. But hey, you got to lose sometime. Yeah. And if you're not focused on the long term, then you shouldn't have bought the company in the first place. But I'm looking 10, 25 years out, and I'm very confident with where I purchased.
Yeah, there are different incentives for pretty much everyone along the chain. And the one thing I will say with the broken IPO thing is it's a bummer when shares are finally publicly available and retail investors get in, and they have a chance to finally buy a company like Lyft or like Uber. And so often those big names are people's first experience with investing. They're like, oh, like I take Ubers all the time. Like I got to get my hand in this. This has got to be a no-brainer. And sometimes people get bit by that. And it's unfortunate. It's a painful investing lesson. But when you're thinking about how companies raise capital, yeah, you want to be maxing out the valuation that you're exchanging your equity for.
Yeah, that's the issue is companies used to come public. I think Amazon came public in the third year of their existence. I think eBay was within the first 5 years. A lot of these companies used to come public so quick because that was how they access capital. Now there is so much dumb money in Silicon Valley where you could be raising $1 billion and you're 2 years old and hey, yeah, we can push off an IPO for 10, 13 years. But it's just times have changed with how companies raise capital and where they can access it. So, I mean, it's great for innovation, but for retail investors, we have to wait a very long time and we might have to pay 3, 4, 5 times as much as we would if they would have gone public earlier. But you always want to focus on the long term. So I always say take that 10-year stance. And I mean, if you're like me, take that 10, 25-year stance and think, okay, yes, this company, say Datadog, it's valued around $11 billion, 41 times last 12 months sales. Pretty hefty. But if they keep these growth rates up, if they can keep it over 60% over the next 3 years, that's not that bad. So if you're focused long-term and you're actually invested in the company, not just for the next earnings report, then I think you'll do well.